We start today's market talk. One of the best risk controls we have as an investor is knowing what we own, why we own it, and how long we will own it for. So we should not invest for long term and then start trading the stock, or get into trading position and then become an investor. So we should be very clear what are we doing, and the biggest risks are always the ones we don't see coming. Economic or market risks are the price of admission when investing. So this is the inherent thing, and Warren Buffett wrote that risk comes from not knowing what you're doing. So be very clear what you're doing in this market. The setup, uh, as I see it, market moved to a new all-time high on Friday, riding on excellent GDP numbers. Third quarter GDP of 8.4% was beyond expectation. Reason for market euphoria is that this performance has come when global growth is sluggish, monetary policy is tight, globalization is on a back foot, and there is an increase in geopolitical conflicts. So the market is expecting that things will improve from here, and that's why they start pricing in better future today only. The good part about these GDP numbers was that the gross fixed capital formation was up 10.6% in Q3 FY 23-24, while it was minus 1.7% in Q3 18-19. The key role in increasing capex was played by the government and household sector. This again, uh, I have covered earlier that government is putting in capex in terms of infrastructure, and households are putting in their saving into real estate. So government has seized the initiative by prioritizing capex by increasing fiscal deficit and borrowing, but it hasn't led to inflation because, as I covered last time, Chinese are exporting deflation to rest of the world, and commodity prices index is at the lowest since December 21. Capex push by the household sector is visible in new houses coming up across cities. Manufacturing sector continues to expand robustly as evident from PMI numbers for February. Manufacturing PMI was at 56.9 in February 24 and better than last month, and services PMI was at 62. There is sign of irrational exuberance in small caps. So what the regulator did, they wanted mutual funds to ensure that their small cap schemes are capable of handling sell-off in frothy stocks, and sharp run-up in these stocks has pulled in investors, leading to flow into mutual funds holding these stocks. If correction is triggered, it could lead to many small and micro-cap stocks hitting lower circuits repeatedly and dampening the investor sentiment. This led to a sharp sell-off on Wednesday, amounting to almost 2% correction in indices. Now, another interesting thing is from that survey which we have seen, household consumer expenditure survey for last 11 years that has recently been released, that the well-off people have done much better in the last 11 years than the masses, which explains the premiumization trend. Now, what this survey showed was that the top 5% of the population accounted for 21.7% increase in urban consumption in the last 11 years. 11 years. This is a category that is driving demand for premium goods and services. That is why it was evident that this segment of the economy is doing well, and this is the way to be invested in. The other point is rich have higher marginal propensity to save. This saving also comes into the stock market, and that is what is causing the boom in the stock markets. Now, one of the stock which is benefited from this premiumization is Indian hotels. Demand expected to grow at a faster clip than supply. The pricing surge witnessed by hotel industry after COVID-19 is expected to sustain in the medium term. It has seen strong demand, robust expansion plans, and Q3 results had double-digit growth and margin expansion due to operating leverage. Occupancies have improved to 76.8%, up 470 basis points. Average room rent grew 17%. Stock is expensive with FY25 expected EPS of around 11. So it is already at 55 times PE, and they are creating many subgroups like ginger, cumin for food, Amma for bungalow stays, Taj Sats, which is airline catering, and they are launching an upscale brand for tier 2 and tier 3 cities in a price range between the Ginger and Vivanta brands. Now, the other stock which had a problem was Paytm Payments Bank. They did a board reconstruction or rejig, but I don't think it is likely to sway the RBI. What is done is being seen as an attempt to buy time beyond the March 15 deadline. Migration of merchants is taking more time with banks worried about redoing KYC for crores of subscribers. So what has happened is Vijay Shekhar Sharma resigned from Paytm Payments Bank board and reconstituted it with independent members. But the point here to note is doing KYC is a cost with no benefit as there is no merchant commission on UPI. Other point is Vijay Shekhar Sharma still holds 51% stake in PPB, that is Paytm Payments Bank. Hence, there is no loss of control as such. It is just that he is not there. Now, what Paytm has done, they have partnered with Axis, HDFC, and Yes Bank to run its UPI services as third-party application providers. But it's not going to, continue for a long time. Now, the other stock which is important is NTPC. The core business of thermal power is thriving while it is plugging into clean energy. Monetization, they are talking about monetization of renewable assets, which will unlock value for the future. Operating performance is mediocre though, despite higher plant load factors, etc. Capacity addition in thermal power in future is driving the growth. Plan is to list the NTPC Green Energy next financial year to cater for their capex requirement. Aim is to get around 60 gigawatt of renewable energy by 2032. It is expected to do rupees 30 EPS in FY26. Hence, it is at around 11 times FY26 expected earnings and with a dividend yield of around 3.5%, so pretty attractive and safe stock. The advantages are that good earning visibility, improving profitability, and a strong balance sheet. Now, I'll just show you Indian Hotels chart. Last year, around February, March, when the movement started, it was at around 300, and now it has nearly doubled in this time. So this is an expensive stock, but this is a sector which is in prominence. It's on a weekly chart. It is overbought. So buy it on dips. The other NTPC, again, this has moved from around. I remember it was below 100. So from 100 odd levels, it has moved to 330 odd levels, and it is somewhere closer to. Once it comes closer to the moving averages of 20 and 50 EMA, that is the time to get it. It generally comes back and tests this. So that is the time to get. Otherwise, it's on an uptrend. Now, coming to certain technical issues, US 10-year yields is a weekly chart. It corrected last week based on basically their consumer data and other data points, which were seemingly weak. So now again, the talk is about some rate cuts coming in near future. So, but it is still above the 20 EMA. So it has to correct below that level for it to have a sustainable trend. Brent crude, again, it had a green week, but it is still downtrending because there is too much of supply and lack of expected demand as such. Dollar index, again, it is stuck in this range of 103 odd. For it to move sustainably up or down, there is a clear direction is required, or some news on rate cut or something like that is required. Otherwise, it will just remain in this range, though it's in a downward trending trend line, and it is impacting the prices of metals and commodities. Sorry, gold on Friday it breached that 2080 level. So let's see from here what happens. This is in clear correlation to the yields going down and the dollar correcting. So the gold went up on Friday. Nasdaq continued last week. Again, it made a fresh new all-time high. It made you can say, a cup and handle, and then it has broken out, and now it is going upwards only, upward trajectory, because of basically their those magnificent 7 stocks are doing relatively better than rest of the market. India's 10-year yield is in a downward trend. It had a positive week last time, but the trend is lower. I think it should go down from here as the time elapses and the rate cuts become more imminent now. And so all the guilds and debt funds and all will do well after this, as the yields will correct from here. So it is best to be with long-term debt instruments at present. India VIX, this is a weekly chart, was very volatile. It tested the 200 EMA, tried to go above that, but then it came down because as the market bounced back. So it was very volatile from 16 out to around 13. It moved. That's around move of around 20% in a week. So this is what is driving the volatility in the markets.
Uh,
Uh,
Tarun, can you dwell a little more on this India
okay,
VIX with regard to the standard deviation and how to go about that?
okay, okay. Okay, that this what happens is uh,
Also about the premiums, when the market is in the positive side, normally you consider premiums are going down, but in most cases we have observed is going up. These 2 points I need to clarify.
okay, sir. What happens is that when the volatility goes up, the 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 uh, the premiums go up, or the because the premiums are driven by implied volatility, which is there for each stock. Now that implied volatility for each stock is listed on the option chain data. Hence, once the premiums start going up, uh, or the volatility goes up, the premiums keep going up. So what happens is that if you're an option seller, that decay is not commensurate throughout the duration of the contract, because even if the stock, say you have sold an option and the stock price is going up, but what happens is uh, that because the volatility is going up, so the premiums keep rising. Also, the premiums are also a function of buying in terms of puts and calls. So if more people are buying puts or more people are buying calls, the premium starts going up on that side. So that means if the market starts going up, the premiums of call side starts going up. Hence, the factor to be noted is that when you are taking a position for, say, option selling, you must see the implied volatility which is listed in the option chain. That implied volatility is for 1 year. So if the implied volatility is 30% listed there and the stock price is rupees 100, it means that the stock can move from 70 rupees to 130 rupees over that 1 year. Now, if your contract, and this is one standard deviation. So, if your contract's duration is only 1 month, so you divide that by 12. That means, say, 30%. So, you divide that by 12. So, that becomes 5, and add 2% to that. Sorry, twice of that, two standard deviation. So, it becomes 10%. Hence, once you take a option position for selling an option, it should be having a margin of safety of around 10% from the market price at present when you're taking a position, so as to have the chances of your option which is out of the money getting into the money is comparatively lesser because because of the volatility of the stock. I
Two
hope I have
standard,
covered.
oh, no, thank you very much, very well covered. Two standard deviation may be a little too conservative. You might not get the option strikes and you might not get the reasonable premium on that. So it may be that one standard deviation, I would say, would cover about 66%.
No,
Uh,
the point is understood, sir. But the point is, one standard deviation is for a month. It becomes slightly risky in a volatile market. That is the only point. So better opportunity. Like what happens in two standard deviation? Generally, you are 98%
yeah,
sure.
yeah,
So it adds a kind of a margin of safety into your position. So that is like a added stop loss. That's what I'm trying to say.
yeah, okay, right.
So
Thank
that
you.
is the point. Okay, next. But you need to watch this because at this time, if you see this India VIX, it is trending upwards, right? from a downward trend, and it went to single digits to around 8 odd levels. Now it is trending upwards, and this is likely to move up uh, as we get closer to the elections. So what is going to happen is all this two-way movements in stocks or in indices during a day will increase. So like now you're seeing two trends or sometimes three trends in a day with respect to indices or stock. It is because of higher volatility. So what happens is, you must have seen that the market or the index opens positive, then goes down, becomes negative, and then recovers. So these two three trends in a day is the one which creates losses and all if you get the trend wrong during day trading or any other if you're taking a trading position. So that is what one has to see. Okay. Next, Nifty. I feel that there is no sign as on date. This is a weekly chart that there is a change in trend. There is no need to be worried because it is on an uptrend. It is making higher highs and higher lows, and all everything is positive, right? So there is the only risk is that there is no risk right now, no risk which is visible. So all the regulators keep making noises and all, but don't stop your investments or don't start booking out on some noise or something like that. It's in a very positive trend, and it is not correcting, and even if it corrects, it bounces back. Now we will see the daily chart. So if you see here, so on Wednesday there was a correction. It tested the 20 EMA Nifty and then bounced back from there, right? It and bounced back from there, and now then it has made a fresh new high. So this is what is it is happening, but it is not breaking this 50 EMA as such. So easily this should be a stop loss, or and you can keep till the time this 20 EMA is not 50 or 20 EMA is not broken, you can easily keep trading because it is bouncing back up also. So there is no fear as such. Now this is the hourly chart for the last week. If you see, it was generally trendless, and then this on Wednesday it corrected, and then on it made a low on that 21,860 level, which I was telling about, it 21,870. It bounced, and on 29th it bounced back from there, and went made a new high, and then on first and second again it has gone up from there. So this is the kind of moment you are getting in a day, sometimes, or in a week. Hence, buy at dips, and if you have to sell at the top. Don't do opposite. Now the stock which is leading the indices is Reliance. This is a weekly chart. It touched 3000 and then it corrected from there. But I think it has touched it once. It will go up again because it has broken the that long term resistance it had around that levels. So it has broken above that. So it is going to comfortably trade above that level. So, and it is in momentum also. So just be there. LNT, as we were discussing yesterday, this is a daily chart. So if you see, there was a gap here. Now it made a rounding bottom, and this gap has got filled on first after this moment in LNT, and now if it closes above this 3740 levels, it will go and make a new high. Now this stock is in momentum because of defense orders, green hydrogen, and the GDP growth resulting due to investments and infrastructure and all that. So this is a clear beneficiary. So if you're here, just stay invested and buy on every dip. So it made a low around these levels, and from there it has gone up. Nifty Bank, so see, this is what is a weekly chart. So it had a positive week and it has bounced above the 20 EMA, and now is trading above. There's a clear trend change with respect to Nifty Bank. So if you see the daily chart, now after the, you see, it was getting stuck. It had bounced from, I think on Tuesday or something, it had tested the 20 and 50 EMA, which are very close. It broke that on Wednesday. It went back on Thursday, and on Friday there was a clear breakout. So after the expiry was over, the short positions have been uh, covered, and now the stock is all the indices and all the constituents have moved up. And I think on Friday, all constituents of Nifty Bank were positive. And here, if you can see, the 200 EMA has provided the support, and it has taken multiple, three times it has taken support there. So this is the level where it is taking support at. So now this is the time. I think the Nifty Bank constituent should also go up. Sorry, this is a weekly chart I have covered. This is a private banks. It has a weekly chart. It has crossed the 20 EMA. So these are looking positive from here. Now, HDFC Bank seems to have bottomed out at around 1350 odd levels. So now it has to close above this 1440 level for gaining some strength, and then try to head to 1500 plus levels. So it will consolidate here in this range, in my view, up to the next results. And in case there is some improvement which is visible from the last quarter, because expectations are very low. So similar to Infosys, it will also bounce back after that. ICICI Bank, this is the trend line, and I was telling you about this, that once it breaks this trend line, it will be a breakout, and it has broken out above that to 1080 level. So it should trade above this trend line. So so if you're taking an option position, better is to keep this as the take 1,000 odd put position. So there is a kind of margin of safety which is 20 EMA, and one can go along with this. For short-term trades, I think this trend line support should be the stop loss. Banks consolidated, but then it recovered back after Wednesday. They recovered their losses, basically led by SBI, BOB, Canara Bank, etc. And it is looking strong now. So it will consolidate a bit. But the best time to buy is this. You can't trade this index, but these stocks is once they come closer to their 20 MA, it has to come back, because it has there's a lot of momentum here, and it is slightly, if you see the RSI, it is slightly overbought also. SBI, it has had a breakout. It consolidated to around 750 odd levels, but again it bounced back on last week, and now it is again at a fresh high of around 770. So the 800 target remains, and it will go above that very clearly. It is slightly overbought, but it is in momentum, and a lot of money is chasing this. Canara Bank is another one. It was in FNO ban, hence it corrected to around 530, 540 levels, but it bounced back very quickly. So now it has reached at 585 levels, heading to 600 prior to that split and all, and it is clearly overbought right now. So that is a thing. PSE index, public sector enterprises, it it corrected, but then it bounced back because of short covering and all. But it is clearly on weekly charts, it is overbought. So be careful with this. Don't chase these stocks. Uh, Among them, Bharat Dynamics, it made a fresh high last week, and it reverted back from there. But the trend is positive, with so much of expenditure taking place in defense and all that, and orders coming in. This one stock which has maximum exports among all the PSU defense stocks. So this is one where one must remain invested if you are holding this. And if you have to buy fresh, buy closer to moving averages. Coal India, after all the negative news, it has a positive news. So I think it has made a base at around 420, 430 odd levels. And now it should revert. And this month's operational updates were good. So no need to worry now. So I think it should go up from here, and they will see what are the operational updates subsequently, because the offtake and the sales and production is every month higher, and now summers are approaching, so the requirement of electricity will only keep going up from the thermal plants. BPCL again. This is one more stock, all the oil marketing companies which are in momentum and which have still some value still left, because now people are seeing that probably the price cuts are not coming. So the prices are higher. And if you see here, it made a low, but it has bounced back. So this is a one sector which is showing a lot of promise, and I think a lot of buying is taking place by FIs and DIs in this. Nifty IT, it made a kind of a rounding bottom. It corrected last week, but I think it will bounce back. It will test its last hour time high above 39,000, and after the results and all that. But it remains positive basically because of the strength in two of its stocks. First is Infosys. This is a weekly chart, and from the high it made a bottom, and then it has retraced 61.8%. So it should bounce back from here. uh, so we have to see this, but I think it should go up from here right now. TCS, again, it has made a rounding bottom, and it has broken up above this 4050 or resistance levels it was having the last high, and now it is trading well above that. So it went below that but quickly bounced back, so that shows there is momentum here, so it should do well from here. Nifty Pharma, it was a index which was strong after uh, October, and it has made a fresh high. All the results of pharma stocks were good. Last week it consolidated basically profit booking, but some of the stocks here have come up with exceptional results. So just remain invested in case you are there. Midcap index, this is a daily chart. Why I've taken a daily chart here is interesting, because if you see here, this is Wednesday. It went below the 20 EMA after Monday and Tuesday were negative, and then it tested the 50 EMA, and then bounced back very quickly on Thursday, Friday, and Saturday. It has again gone up. So I think the correction is over now, and so it should go up from here. Similarly, small cap index weekly chart. So if you see here, uh, it has made four negative weeks. So that means it has been negative for a month or so now. It has moved up a lot, so it should consolidate. And then once the moving averages catch up with the price, and then it will restart its rally. So if you are there, there is no need to no need for any kind of panic here. Now, few stocks which are looking good. One is this is Shriram Finance. So it made firstly, the price action is showing an uptrend. It made a inverted head and shoulder pattern, and this is a daily chart. It went down because of there was some doubt about whether it will get included in Nifty and all that, but it has been included in Nifty 50. Hence, it should do well. It's a very strong stock with good operational performance and relatively less expensive as compared to other NBFCs. Hence, this should do well from here. The other stock is Tata Motors. Uh, it's on a steady uptrend, and it's made a minor. It had a minor breakout after making a cup and handle trend. I think it should, once it crosses 1,000, it will go another 50, 100 rupees after from there. So again, this is the one stock which is in momentum, and RSI is also indicating that. The other one is Suzlon. So if you see here, uh, it went up to around 50 plus, and then it broke down, and it has tested the rising trend line, and then it may bounce back from there. Uh, so if it trades above this 20 EMA, then it can again go to 50 and 53, 54 levels from here. So just watch whether it takes support here or breaks down from here. Okay, the few stocks I'll cover today. First is IDFC First Bank. Uh, this is a very popular stock, and that is why one has to be very careful with this stock. They reported a third quarter FY24 profit after tax of 720 crore, up 18% year on year, but it was 8% missed from basic analyst estimates due to higher provisions and operating expenses. Cost to income ratio also remains elevated in the near term, mainly due to need for deposit mobilization at a healthy run rate and continued investment in business, technology, and branches, because they are a growing business. And we have seen now there is a actually a dogfight among all the banks to get deposits right now. So the cost of taking deposits will be higher, so the cost to income will be higher, so that impacts the margins. It unveiled Guidance 2.0, under which it targets 24.6% CAGR in deposits and 20% CAGR in loans over FY 24-29, that is next 5 years, and that led to the correction, because earlier they were guiding around 25 to 30%. So moment they reduced that guidance, the market said that why should we give you such high valuation? Asset quality remains stable, with GNPA ratio declining by 7 basis points Q on Q to 2%, and NNPA, net NPA ratio remaining unchanged at 0.68%. Return on assets stood at 1.16%, at high OPEX remained a operating expense remains a drag. In October 23, the bank was able to successfully raise 3,000 crore through QIP at around rupees 94. The balance sheet expanded 22% year on year. Lending and deposit mobilization stays strong. In next 5 years, the bank is expecting to open 1,700 to 1,800 branches. Now let's see the result. This is the third quarter results which was achieved. So if you see the here, net interest income was higher than the estimates, and the operating expenses were also higher, and net profit was only up 18.4%, while expectation was around 28%. There was a decline versus estimates of around 8% in net profit. And if you see here, the provisions have gone up. So this is in billions. So that means provision from 530 crores have gone to 650 crores. So that impacted the profits and the margins. Now, deposit growth, if you see here, is still good, 37%, much better than others. But the loan growth is moderating. It is still 27%, but they are guiding for lower growth in future. The asset quality is decent. Gross NPA, net NPA, and provision coverage ratio is also 66 odd is okay. Now, this is this quarter results. Hence, the stock declined. Now I'll show you more. So NIMs are good at 6%. It is exceptional, this kind of NIM position, because just for information, the best banks like ICICI Bank, etc., are at around 4, and HDFC Bank has dipped to below 4, around 3.4 or 3.5. So NIMs are best in class. CASA ratio increased 40 basis points to 46.8. Again, this is very good. That means they are working on improving their CASA deposits vis-a-vis retail deposit. This is against the trend, because we have seen most of the banks, because of higher cost of deposit, had shown decline of CASA ratio. Here it is improved. Customer deposits grew 43% year on year, which is again good, and there that means they are not going for wholesale deposit. Cost to income ratio remained elevated at 73%. That is because of higher operating cost and higher cost of deposit, so that is impacting their margins. Now if you see their future guidance, now this is in billions of rupees. So they are targeting around, if you see, net interest income growth of around 20% over FY 25-26, which is pretty good. Total income growth also in similar range. Uh, Profits to be growing at around 30%, which is very good right now. Uh, and they are targeting an ROE of around 11 to 13%, ROA of around 1.3 to 1.3. Uh, and if you see here, now this is a key issue. Uh, the book value FY24 is 47, is expected to be around 53 and around 60 in 26 FY26. So right now it's at 1.9 times book value. We will see what is the state of affairs of other banks. Now let's compare it with other banks. So this is City Union Bank, Federal Bank, Bandhan Bank, RBL Bank, and IDFC Bank. Now, very simply, if you see the ROAs, they for IDFC Bank, IDFC First Bank, they are comparable with all the other banks which are that medium-sized private banks. ROEs are also comparable, nothing exceptionally great. They are actually lower than the others. Uh, and now let's come to price to book. Now here if you see for FY24 it is around 1.9 while others are at 1.3 1.6, that is Bandhan Bank, but that is again very expensive bank. So others are trading at lower price to books with similar ROA and ROEs and similar. Now if they're all are moving at the same growth rate, then this is what the market is thinking, that why should we give such a higher multiple to IDFC First Bank, and that is why the stock corrected from close to 100 level to around 80 now. And this is the key reason why there is a, because one moment they reduce their guidance to 20% from 25% at present, this correction took place. We have seen provisions have increased. Guidance is of around 2% ROA by next 5 years. We will see that, and 17 to 18% ROE, etc. Cost to income ratio is again higher because the bank is in an expansion phase. They are making branches and all, and initially branches don't make profits. Bank will still deliver 30% earning growth CAGR over the next 2 years, as I show you. I've shown you the book value. So FY26, you can give a target around 1995 to this stock. And for FY25, it should be around 80-85, where it is now. The other point to note is that credit to deposit ratio was at 101.6% for this quarter. Now, the similar problem was also found in HDFC Bank, where their credit to deposit ratio was above 100. So most of the PSU banks you would have seen, they are at around 80 or credit to deposit ratio. So again, there is a problem because they are not able to maintain their credit growth with the present deposit growth. They have improved their liability franchise because the deposit grew 37%, but it is increasing their cost because they have to provide higher incentives to get deposit. Uh, CASA ratio we have discussed is good. So the net result is, if you see the technical chart, the stock is in a declining trend, and it is coming now closer to its 200 EMA, which is at around 80 odd. So this is the problem, and that is the reason why the stock has corrected for all these reasons. Now it's a declining trend line, so it has to break this. So if it has to break above this trend line, so as to get some momentum, otherwise it will just remain in this trend. So there is no point chasing this one till the time there is a momentum on the any direction right now. So that is the why right now there is no need to buy it or sell it and all. This will remain in this range only because it had moved up too much in this period on higher expectations of growth, which have got negated now. Okay. The other stock I'll cover is Happy Forgings. This is a recent listing. It ranked as the fourth largest engineering led manufacturer in India for complex and safety critical heavy forged and high precision machine components. It's a supplier to each of the top five Indian OEMs in the medium and heavy commercial vehicle industry and to four of the top five Indian OEMs in farm equipment industry. Happy Forgings is a major revenue is contributed by crankshafts, that is 47%, wherein it has a market share of 45% oblique 35% in commercial vehicles and tractors. The share of machining mix in the company's revenue has increased to 84% in last 3 months from 53% in FY14. I'll cover why it is important, this improvement in machining mix, better than the forging mix. Following the successful installation of this 14,000 ton press, uh, Happy Forging experienced a major influx of new order win from industrial segment, highest EBITDA margin among its peers over the last 2 years, primarily due to superior machining mix. its exports have now surged to 20% from for 3 months FY24 from just 13% in 9 months FY23. That is over 1 year. Exports have gone up. Additionally, its industrial segment contribution has increased to 13% from just 4% last year. It has integrated manufacturing operations coupled with in-house product and process design capabilities, resulting in a diverse product portfolio with continuous value addition. Now, if you see here, uh, this is in millions. So it is expected to have a sales growth of around 20% over the next 2 years. Once all this stabilization comes place, and margins are going to improve to around 30%. Uh, and if you see here, the adjusted PAT is going to improve around 30 to 28%, and they are expected to do around 408 crore of PAT in FY26. So it is on a continuous improvement path. So now if you see here, this will have a EPS of around uh, 43 in FY26. So FY26 earnings will start getting discounted after 3 months. So presently it is at less than 25 times FY26 earnings. And most of the return ratios are improving. The working capital ratios are improving. The debt is not there, so that is good part, and going to give dividend, etc. So it's on a positive path. Now, if you see here, which I was telling about, revenue mix percentage of industrials continue to expand. So if you see here, it has five major segments. Uh, This is commercial vehicles, farm equipment, off highway vehicles which run on ground and all that, industrials and personal vehicles. So what is happening is, from revenue mix which was primarily commercial vehicles and farm equipment is now going down, and the mix of industrials is going up, which is good because then this business doesn't become cyclical. And share of exports revenue again is increasing, so it is decreasing the country risk. Forging capacity is likely to increase. It's increasing every year now, and revenue is expected to grow around 21% CAGR over the next 2 years. Now, if you see here, revenue mix of crankshaft has been increasing now. It had gone down and now it is increasing, which is a major requirement for any uh, commercial vehicle, along with increase in machining. So machining mix is overall revenue is around 84%. It's a better margin now. Continuous addition of new clients. Revenue share of top 10 clients has declined over the next 3 4 years, so which is good because it is becoming more diverse now. It is not dependent on few customers only, and share of customers with less than 5 years relationship has increased. But also point to be noted is, greater than 10 years there are still 73% customers are there. So that means there is a maintenance of relationship with old customers, and it is adding new customers. Now, what it does, if you see here, a crankshaft, front axle component, differential case, suspension for commercial vehicle, tractors, off-highway, industrials, uh, various parts for wind turbines, oil and gas, transmission parts, railway parts, and passenger vehicles, again crankshafts and all. So if you see here, the product mix as such from commercial vehicles is decreasing, and for industrials it is 21, increasing from 14 to 21%, and for off highways, for tractors and commercial vehicles is decreasing, and it is again going into passengers vehicles also, that which will make the revenues less cyclical. So what it does is, it manufactures and delivers top quality intricate components. I have told you about the segments. Expected to do around 2000 crore revenue in FY26 with 30% margin and PAT of 400 crore. Second company in India to have 14,000 ton forging press. If you see here, greater than 14,000 ton forging press in India is now only with Bharat Forge and Happy Forging. So again, it gives them fresh kind of contracts and all that, uh, and makes them capable to forge heavier safety critical parts up to 250 kgs. Uh, that is one. And now here, if you see the EBITDA margins, see here, it has better EBITDA margins as compared to the balance forging ecosystem. Bharat Forge, Sona BLW, Uno Minda, CI of India, Craftsman Automation, Ramakrishna Forging, Sansera Engineering, Forging, Endurance Technologies, etc. Much better margins. Uh, so right now, major share of revenue is from commercial vehicles and farm equipment, but contribution of industrials, as I showed you, is increasing. Healthy profitability with improved utilization should help the cash flows, and better return ratios will help. Uh, they have guided for a capex of around 200 crore per year for next few years, and it can easily, if you see the FY25, FY26 earnings, it can trade at roughly around 1000 to 1100 very easily. Now it just recently listed, so the technical data is less, but if you see here, uh, this is the daily chart. It broke after this interest. This broke out above the 20 EMA on Friday. So if it trades above the 20 EMA for another 2 3 days, that will be short term breakout, and then it can head to 1000 plus levels. So the stock to be held for long term. The next stock is Kaynes Technology. End-to-end and IoT solutions enable integrated electronic manufacturing in India, having capabilities across the entire spectrum of ESDM services. ESDM is Electronic System Design and Manufacturing. Third quarter revenue, EBITDA, PAT surged 76%, 70%, and 98% year on year, up 41%, 43%, and 40% Q on Q. Now, how many companies have you seen where the Q on Q revenue, EBITDA, and profit after tax growth is 40%? So that is why this stock is uh, a stock to be held. Fourth quarter is likely to clock strong 600 crore plus revenue and 15% margin because of superior product mix and cost saving. Strong order book is of approximately 3790 crores, that is 3.4 times FY23 revenue, driven by industrials, electric vehicles, and railway verticals. It will do OEM, ODM business for Kavach railway systems. It has received large orders in aerospace and EV segments. Significant revenue inflow likely in FY27 from OSAT business. OSAT is in great news. Outsourced semiconductor assembly and test. What OSAT does is it takes the bare wafer silicon and converts it into a packaged product. This is around 18 to 20% EBITDA margin business. This this would be operational in FY27, or you can say profitable in FY27 as claimed by the management with asset turnover of 1.5x. That means they will at least the revenue will be 1.5 times their investment in this segment. It has partnered with DigiLens for augmented reality and mobile computing in Asia Pacific region, and will manufacture scalable solutions for commercial, industrial, and defense markets in India. It has also partnered with tech developers in high complex AI-driven products used in cybersecurity. It will be the first Indian company to supply CKD servers. CKD is completely knocked down servers to global OEMs. Basically, you break it into parts and supply it, and then they assemble it. So that makes the transportation easier. It has signed MOUs with state governments of Karnataka and Telangana to set up this manufacturing facilities for OSATs and PCB manufacturing. Hence, the margins for box build and aerospace and defense are higher, which is going to be the focus in the next quarter. Hence, it is expected that the margins next quarter would be better. Now, we will see this. If you see this, this is third quarter FY24. This is in millions, so it did around 500 odd crores, 76% year on year, and 41% Q on Q growth. And 3 months it is up 53%. EBITDA again up 46% and 40% Q on Q. But the key issue here is that the finance cost is going up because it is now taking up higher debt. So this is the point one has to focus on. The PAT was up 98% from year on year, and 40% growth, which is there Q on Q. The total expected EPS for FY26, I'll show you. FY26 expected EPS is around 45. So 45. So if it's at 45, presently it is at around 70 times. So it is expensive stock. So not don't expect any big movement from here. Uh, the key issue to see in all EMS stocks, that electronic manufacturing stocks, is EBITDA margins, because here they are adding some value here. That's why it is in double digits. Interest expenses are expected to remain higher. This is what I was telling about, that one has to be careful with its debt. This is his balance sheet. So if you see here, debt is going to around 2200 odd crores for FY26, and nearly doubling from FY25. Hence, one has to be slightly careful here, because if the revenues decline and the margins decline, then the EPS will go down very drastically, because then they will not be able to service their debt. Rest, all the parameters are okay. So if you see this stock, this has had a continuous run upwards only for the last year plus, and it has reached the 3,000 odd levels now. And in my opinion, it is fully priced at these levels, but it is in momentum, and expectations are that it will keep doing well. So every dip here closer to 20 and 50 EMA, it tests that. On bad days, it goes and tests that and then rises from there. So this is a place where you should accumulate this stock. So I have finished. We'll take questions from here.